Okay, a few words on the applied level before we head in. I had so much more that I wanted to add, but I don't want to make these too long. I'm thinking of just doing a separate video just for the applied level because there's a bunch of information I want to add. But we'll go with the two big announcements. The next Costa Rica retreat is February, March, and April of 2026. I had made this announcement, I think, two Sundays ago, and I was going to run 6 weeks, and I have the weeks listed here: week 1, 2 in February, the first week of March. Then I take a week off. Then I have 3 more weeks, which end at the end of April. That was the 6 weeks I had planned, 4 to 5 per week, 24 to 30, but 23 have now booked. I did open up the other 2 weeks at the end of April, so that gives us 32 to 40 spots total. 23 have booked in the first 2 weeks, so we only have anywhere from 9 to 17 spots left. If you are interested, the email is meldrum.b.m@gmail.com, and I'll send you a PDF which describes what the week, what's involved in the week, or what we're covering during the week. I don't anticipate that by the time we get to the end of October that any of these will be left, which means the next session is August, September of 2026. This is the rainy season, although this year it really didn't rain that much. August was rather nice. September, there was 1 week where it did rain like every freaking day. But overall, it wasn't as bad as I thought it would be. February, March, April, there is zero rain, zero humidity. It's just sunny and hot. And we do have a nice big pool. And we do have 4 horses, so if you like horseback riding, you can do some horseback riding during the day as well. And then we do have day trips. We get you to a volcano and a coffee plantation. We'll get you to a waterfall garden and a beach and things like that. Fun stuff. In the energy sector, for sector studies, all the PDFs are now posted. You can see we have a PDF up for the main energy sector, and then every sub-industry: oil and gas drilling, oil and gas equipment, integrated oil and gas exploration and production, refining and marketing, and storage and transportation. Coal and consumable fuels, uranium is in there as well, also is in the energy sector. And then we have understanding hydrogen, which is not a sub-industry, it's just a theme within energy. Understanding carbon capture and sequestration. And what is still coming is understanding liquefied natural gas. Those don't fit nicely in any of the sub-industries, although we can squeeze them in somewhere. Something like carbon capture and sequestration is done over all the sub-industries, and especially in hydrogen as well. This is from sector studies. In applied asset management, under trading manuals, you'll find derivatives trading for your U.S. energy sector. And here we cover all the futures contracts for oil, gasoline, heating oil, and ethanol, and different trade setups, curve trades or directional trades. The energy sector also has a Q bank. There's 365 questions currently in the Q bank from all the sectors. 11 to 1200 are planned because I want roughly about 100 questions per sub-industry. I'm still going to continue to add to that. And then for the infographics, one for the sector, there are 2 industry groups, there are 7 sub-industries, and I highlight 52 companies. Across all the 7 sub-industries, we have 52 companies, so an average of 7 to 8 companies per sub-industry that we do profiles on. And beginning January 1st, because we're almost done this whole sector, I'm going to offer an energy sector specialist designation. I've been able to find places that proctor online exams. I looked at this a couple years ago, and just the cost to have an exam taken online was almost It's $250, $300 a person, and that's what you had to pay the proctoring company just to do the exam. So you got to start your pricing at like $300, and that just covers the exam. There's a lot more competition in this space right now, and depending on the size of the package that you buy, you can get it down to as little as $17 an exam, but you're spending $200,000 a year because you're buying so many seats to get it down to 17. I can't justify $200,000 a year because you'd need thousands of people taking that exam. Even if 1,000 people took it at $17, you're only at 17,000. So you can imagine, you need, over 10,000, 15,000 people taking this exam. That's just not going to happen. So based on just estimates of, let's say, 150 people that would want a energy sector specialist designation, you're down to about 100 an exam. That starts to be realistic. Instead, so now you don't have to price this at $595 or $695 just because the exam is 50% of it. You can price something like this at about $295. And you can bundle it, and if you do this, then you have to produce videos for each of the 13, I think there's 13 chapters, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This will be 11, and the derivatives trading is 12. No, there's 12 chapters. And these chapters are long. They're anywhere from 40 to 70 pages. Call it an average of about 50 to 55 pages per reading. You got about 600 pages. And it's not just a light treatment of each one. It's a deep dive on each one. This one here, derivatives trading for the U.S. energy sector. I had somebody who works on a derivatives desk, not just energy, but they do other products as well. I had them go over it for me and make a few little suggestions and corrections. And introduce language saying this is the language of a trading desk. So there's different types of language in there that how somebody on a trading desk would speak. So that one has been looked over. So I am thinking about doing something like this starting January 1st. It is going to take me probably the better part of 2 to 3 months to develop all of the videos for these because they are long. I don't want to do it if no one's interested. So we'll leave it here. If there's interest in something like this, leave a comment under the in YouTube under the video saying that just something as simple as I would be interested in that. I'm seeming to think that would land somewhere around this price, and that based on the amount of packages that I would buy for exams would end up somewhere around there on the exam cost. And if you're interested in Costa Rica, just send me an email. The spots have gone quickly. I don't anticipate that by the end of October there'll be any spots left. And I will be putting out a longer video on the applied level because there's so much more content now, and I think that maybe some people don't have an appreciation for exactly what's there or how much is there or at what level it's written at. So I'll put out a longer video on that. Okay, let's head in. Well, we have a week without any significant data. We have ADP to go by, and we have some private sector data, ISM, and then we have a government shutdown. But we're missing a key piece of the puzzle for rates, which was the jobs report. Although there is some criticism that the sample size, the response rate of the jobs report is smaller and potentially biased, so maybe we weren't getting the best information from that. So we're going to go with what we have. As of the time of narrating this Sunday morning, I hear no solution to the shutdown. The last one that Trump oversaw went 35 days. I don't know that the Republicans have any motivation really to end this one. They do want smaller government. This will do it. They do want lower rates. Well, less inflation will do it. Well, 750,000 people are furloughed, and many people aren't being paid. So that money can't be spent. So I think as far as the Republican side goes, they can dig into these trenches for quite some time. Let's have a look at what we had. Money market rates all fairly well behaved, and on the capital market we have yields coming down, but they come down, they go up, they come down, they go up. It's exhausting. So I'm not getting too excited about this, saying, we're going in the right direction. I think a firm close on the 10-year below 4% and holding that for a while, now that's something to say, okay, it looks like we're getting somewhere. It looks like the narrative in the capital market for bonds at least has been shifting. Good. But until then, this could just be, well, good this week. We're going to take it back next week. October 29th, FOMC is only 24 days away. This is right, 96% on a 25 basis point cut. I would seem to think that if we match another 35 days on October 29th, you could go 50 on the reasoning that if you're going to cut again in December, if the committee feels they're going to cut again in September, with a significant part, like 2 million people not being paid, that would justify 50 points, I think. We'll see what happens. We get September minutes in 3 days. Remember, the Fed is independent, so they do continue to get paid. 3 days, we'll have that release. Also, on Wednesday, we have the 10-year auction, and Thursday, we have a 30-year. I was thinking, hang on, we're shut down. But this is a government funding shutdown, not a debt ceiling. So this will continue to be issued. Our curves are still upward sloping. The key one, the 3-month to the 10-year, still upward sloping by 10 basis points. TLT had a good week, up 0.54. SPX up 1.09, all-time highs again. Dollar index, nope, 97.92. 96.93 is the near-term low. That was hit a couple of weeks ago. If you take out 96.63, that takes out the February 22 low. You'd have to go back to 2022 to get the dollar index that low. I personally think it's inevitable. I think less than 90 is probably in the works for the U.S. Over the next. I don't think it's going to run there. I think it's going to be a slow drift downwards as the market sees that most central banks are probably near the end of their rate cutting cycle, while the U.S. is just beginning their rate cutting cycle. Interest rate differentials would suggest that the U.S. dollar would drift lower. We do have economic data from other countries. Canada, the August imports get in 2 days, and we get the Canadian jobs report in 5 days. You can't stop them from speaking, no matter what kind of shutdown you have. Look at all the Fed speak, and you have Powell in here. You also have Mirren in here twice, but Mirren's had one speech once and not one blip in the market. Then he had an extended interview on Bloomberg last week where poor little fella, almost incoherent in some of his thinking. Some of his theories are, he's grasping for anything he can to please the president. I don't think that's really worth listening to anymore. So there it is. This is the big one, Powell at 10:30. Reverse repos, 25 billion going into the weekend. The lowest was hit on October 2nd, less than 10 billion, 8.4 billion, a rounding error here. So that would probably hit zero at some point. Look at reserves under 3 trillion now. I seem to think they're about 2.5 trillion. They're going to start to wonder where is the level of ample and probably end balance sheet runoff. I know the Fed would like to get that balance sheet down from a little over 6 trillion to somewhere around 4 or even $3.5 trillion. They have 2 point some trillion in mortgage-backed securities on there. I don't think that's going to happen. I would bet 10 trillion before 4 trillion. I think once we get past Powell, I think the conversation between the Treasury and the Fed is going to shift to the biggest emergency the U.S. has looming is the unsustainable path of the debt because of the continual deficit. That something is going to have to be done. That's going to become a big problem, and the Treasury's not going to solve it alone, and the Fed's not going to solve it alone. And don't look to your elected officials to start doing the right thing. They will do the right thing to get elected. And as Mitch McConnell once said, no one ever lost an election because they spent too much money. So they're going to continue to spend. With population growth in the U.S. at stall speed, you have no immigration, virtually no immigration speak of coming into the country. Your baby boomers started retiring, the largest cohort started retiring in 2010 and will for 20 years, 2010 to 2030, 10,000 a day. But those that started retiring in 2010 are 80 years old this year. That cohort, that graduating year, the 2010s, are 80. This is when you have to start thinking about birth versus death. And with it being the largest cohort over the next 5 years, you have just as many people retiring probably as leaving the planet. So we are facing a sort of a Japan style, I shouldn't say we, it's not a we, US is facing sort of a Japan style growth phase. The reason Japan has not seen inflation for such a very long time is they have been, I wouldn't say anti-immigration, but certainly not high on their list. Stagnant population to population declining. There's no inflation in a scenario like that, and with a very old population as well. So they were able to keep rates very, very low because there was no inflation. Well, look what the U.S. is doing with their population now, emulating sort of Japan's path, and with their debt, certainly emulating Japan's path. They cannot afford this interest rate. And if they continue on with this, who is going to be the marginal buyer of U.S. debt? It's going to have to be the Fed. The Treasury under Besant wants a 10-year at 3%. We're at 4.13. That's a lot of heavy lifting you expect the market to do. Given the policies of this administration, I don't see that happening. So the Fed is more than likely going to have to step in, and inflation from population growth, I don't see it. From tariffs are a small part. It's on goods. It's a small part of the U.S. economy altogether. And companies are showing that while they are getting some cost reductions from suppliers, they are shifting to lower tariff regimes and cost cutting at the same time. Every company that has announced a hit from tariffs has also announced plans to rationalize their workforce to offset those. If they felt that they could pass those costs through, they would just say, we're going to raise guidance because we're going to make it from a mix of product and price. But they're not. They're offsetting those. I don't see a way out of this for the Fed and the Treasury under a Trump-appointed leader at both. I see cooperation. I see pointing out the MBS saying, why don't you sell the MBS and buy the 10-year? I also see balance sheet runoff is ending soon because look at where your reserves are. And even increasing if you cannot get that 10-year down fast enough. Let's have a look at the Fed funds futures. For what I've done along the bottom, this October, November, December, January, February, the M means there's a meeting, a Fed meeting. So October we have a Fed meeting, and December we have a Fed meeting, and that is the end of 2025, and then you start 2026. A cut and a cut, two cuts, I think, is what the market is pricing in. 46 basis points by Q4. If we look at the January ZQ, which is the average over the month, showing 46 points down, two cuts. Then you have three meetings with Powell, January, March, and April. I'm going to be very conservative and say one cut in there because I think Powell might want to get to what he thinks the neutral rate is by the time he leaves, cement his legacy and say, look, I got you to neutral. What happened after is not my fault. I think that's probably what he might want to do. So one cut, which the market is pricing in one cut. This is where I think they go wrong. You have three meetings here, June, July, and September without Powell. Assuming one cut in here in these three meetings with a Trump-appointed head of the Fed, a Trump-appointed chair, with 3, 4, 5 people he'll control. The court case, the Supreme Court case for Cook, is delayed till January. So Trump can't fire her till January. But you must understand that is a win for Trump no matter what. That is a win. I've said this before. Trump's MO is not only must he win, you must lose. You can't just not lose anything and him win. No. You must lose and lose badly. You're delaying this till January. Let me tell you something about having litigation lawyers in your corner. You're going to get billable hours every month. Every month, billable hours. She is going to be hit with a bill for September, which will happen. It's probably already happened. 40, 50, 60,000. She'll be hit with a bill for October. Put another 25, 30,000 on that. She'll be hit with a bill for November, a hit with a bill for December. And you may say, but the court case is until January. I would then answer, you've never had a lawyer, have you? They bill you every month, because of course they have to prepare. And if you say, well, can I come in and watch what you're doing? Oh, you can't do that. You can't do that. You can't see what we're actually doing. Billable hours, billable hours, billable hours. Her finances are going straight down, and the stress on her. If you've ever been in a lawsuit, no matter what side you're on, it's the stress because of the lawyer. What's the lawyer doing? What's the bill going to be? You get that email from billing on the 3rd or the 4th of the month, and you're looking at it, and the PDF is attached, and you're terrified to open it because it's going to be a ridiculous price. Anybody out there who's been through this knows exactly what I'm talking about. Even if you know you're going to win that case, you'll never be made whole. Your lawyer knows it, and your lawyer is going to bleed you dry. Wait, did I say lawyer? Put an S on the end of that. Lawyers. This is the Supreme Court. She's got a team on this one. Trump wins. Why? What's his cost? Nothing. The taxpayer's picking up the tab on this. He doesn't pay a single penny. He's not paying anything. So the longer this goes on, the more it costs her money, the more she loses. Even in the end, if she gets to keep her job, she'll have no savings, and probably owe much of her future income, and probably would have mortgaged her house significantly to keep this. I don't know that it's worth keeping a job like this. It won't end either. So anyways, let's get back to what we're doing here. February, this is where if Trump can control much of the Board of Governors, and of course January is the Supreme Court case for Cook, the decision, then he doesn't have to reappoint Fed presidents who do not agree with him. So that by the time he gets over here, I can't imagine one cut. I think you're going to get 50, 50, 50. You're probably looking at about 150 basis points of cuts along with the 75 I think we're going to get. So 200 to 225, that is right where Stephen Mirren is. I think he is not the person to listen to. He is a puppet. What comes out of his mouth are Trump's words. I would listen to that. That's sort of what I would think is where ZQ is going to be. And I have a very large position on ZQ now. October, I got 347 contracts. So every point ends up being a lot of money. In Canadian dollars, it's like 20,600 US dollars, something like almost $15,000 per basis point. But I seem to think that 98 in October is the right value. My average price is 96.966, just below 96.97. If we get 4 cuts, we end at 96.92. And I think if you say one here, one with Powell, and only one without Powell, let's be reasonable and say, okay, one without Powell, 96.92. I think my downside is like 65,000. My upside on this is in Canadian dollars somewhere around 2.1 million. So I am sticking with this one. Real yields have all pulled back. And there's the critical one for gold, and we'll look at gold a little later on. We'll see that it hit all-time highs again. Nothing to see on corporate spreads, by the way, whether it be investment grade or high yield. Nothing to see here at all. Break-even rates all a little lower. That would make sense given that we have a government shutdown. All of that spending will be taken out of the economy every 2 weeks. Now, many of them will get their money back, but not the ones who are contracted. They won't get their money back, but furloughed will get their money back unless we start big, massive layoffs. So this to me seems consistent. 30-year, 6.34, still got the 6 handle, up 4 basis points over the week. Pending home sales, we had that data last week, up 3.8% month over month. House pricing index, very backwards looking July. Down 0.1 nationally, large cities, Case-Shiller down 0.3. This is month over month. We did get some data last week from private entities. ADP, September, 32,000, negative 32,000. August revised to negative 3,000. The expectation was for plus 50, negative 32. Challenger job cuts, 54,000. That's rather benign. The month before was 86,000. We got our ISMs, the manufacturing and the services. Manufacturing in contraction, 49.1. Expectation was for 49, so it beat the expectation. Came in higher than August. Employment slightly higher, but still in contraction, 45.3 versus 43.8. New orders, 48.9. Much lower than August at 51.4. New orders now in contraction, and prices easing off from August. So not good here, and still in contraction, but better than the month before. So it's not contracting, or it's not as a deep contraction as the month before, but it's still a contraction month over month. So you can think about it this way: contraction, it's starting to do this, right? You have a second derivative on this one here. So the decline is less and less, but still contracting. ISM services, 50, stall speed, 52 the month before, expectation 51.7, so that is a big deal. Employment 47.2, still contracting, but not as much as the month before. New orders 50.4, down from 56. Look at new orders for manufacturing, new orders in services, all of them down. Those are leading indicators. Prices pretty much flat, 69.4 versus 69.2. And mortgage apps ending the week September 26, down 12.7%. So employment on both are in contraction. New orders on both, on one is in contraction, on the other is near stall speed, but significant step down from the month before. This does look like an economy that does need some support, both in jobs and in the economy itself. This does not look like an economy that needs a Fed funds rate at 4.08%. Okay, a little AI output here. This is from Perplexity. I asked about the state of the government shutdown versus jobs and paychecks. Tell me something about it. I asked Google as well. You know what I got? A list of websites. But I have asked Google other things like, just the state of the, nature, things like that, just general stuff. And I get perplexity-like answers. But when it comes to anything political, it gives me a list of websites on the default that you make up your own mind about what you read. So anything it deems sensitive, it's going to give you a list of websites. It really has to get past itself and its wokeness here. It really has to leave that behind. You ask it to generate any picture that it deems unsafe, it won't give it to you. I asked for a middle-aged man one time who was overweight, wearing an angel costume, because I'm trying to resurrect Rodney. Oh, that's an unsafe picture. It won't give it to me because it's unsafe for society. Like, seriously, man. Anyways, list of websites. Google. Oh, I did buy the Google Pixel 10 phone. In Canada, I think it was like $1,600. And you get 50% off the buds. So I've got that, and I set that up. I haven't tried it yet. And I got the AirPods 3. Both have live translation. The Google apparently is going to be a lot better because it has more languages. I just haven't tried it yet. And I got another delivery over the weekend. I will show you pictures of that when I get that here. So let's see what we have. Current U.S. government shutdown already resulted in significant disruptions to federal jobs and pay, especially among non-essential government workers. 750,000, 40% have already been placed on unpaid leave, furloughed. And this point here, in past shutdowns, furloughed federal workers were eventually given back pay when the government reopened, but contractors such as janitors, security guards are not guaranteed back pay and may lose income permanently. Don't know how many people those are, but it's not as if this money is gone. It's just it's going to build up, and then they'll get it back once they get a funding bill for the government, unless they go in with that chainsaw and start cutting people, right? The White House has indicated a willingness to pursue mass layoffs, reduction in force, if the shutdown continues for several more days. Well, it has continued for several more days. So let's look at the week coming up. Maybe that's the economic data we get on the jobs front, is how many layoffs are you actually going to get? It will be challenged, of course. Everything is challenged, but Trump doesn't pay legal fees. So making this the first shutdown where permanent federal job losses are an explicit possibility. But you can always go with, Trump's MO. This is his MO, threaten and bully, and then taco in the end. So, yeah, he's threatening to lay off a whole bunch of people. But will he? On the one hand, you have to think about the size of government versus the revenue. You have a deficit. So either your revenue is too low for the size of government, or government is too big for the size of your revenue. You either raise taxes, which that is what tariffs are doing, or you lower government expenses, or a little of both. So you've got the tariffs, you've got the income coming in. Maybe you need a little bit of the other side. It is all of your dollars. If you're American, every single penny you pay in taxes goes to pay for all of this stuff. If you want to keep paying for stuff you can't afford, then that's fine. But job losses, we can get that next week. On the one hand, I think it is necessary for government to become smaller. On the other hand, it is a loss of income. But it could be that the private sector could absorb most of them, so maybe it isn't so much job loss as job switch. Let's see what happens. If shutdown persists throughout the main survey week for employment data, I think that's up to about the 13th or the 14th of the month, the temporary layoffs could cause a one-time spike in the unemployment rate, potentially pushing it to 4.8% if the shutdown persists. We say the main survey week for employment data, but unless you get a resolution, who's going to count that? There'll be no data collection. Prolonged shutdowns can hurt private sector employment among government contractors, which may lead to additional furloughs and a broader drag on economic activity. This number is being thrown around a lot. Each week that you have a government shutdown takes off about 0.2% to real GDP. As of Wednesday, that'll be the first week coming up. So there is 0.2 gone. Next Wednesday, another 0.2. Next Wednesday, another 0.2. This is why I think you have the real possibility of 50 basis points if this persists all the way to the Fed meeting. No data, no visibility, but this rule of thumb, now I've heard it anywhere from 0.1 to 0.2. You know, there it is. So I say no resolution by October 29th, no data, 50 basis point cut, perhaps. So Perplexity is useful for this kind of stuff. It can give you a bunch of stuff in a compact form that you can read. And it gives you all of the references, which I really like, because if you read something, you go, that doesn't sound quite right, or I don't quite understand that. I can go to one of the references. Google just gives you a list of websites for anything it deems too sensitive for you to read. Okay, Nike. Let's take a few minutes on this one here. September 30th. Reported their first quarter 2026 earnings. Revenue $11.72 billion. The expectation was for $10.99. That is nice, up 1% year over year. You have a growth company. Growth, well, 1%. I mean, compared to what we expected, let's live with that. If you adjust for currency exchange, it is down 1%. So if you go back last year and say, let's freeze the currencies where they are, you're actually down 1%. EPS 49 cents per share. The expectation was for 27, so that is really good. However, it is down 30% year over year. Gross margins, this is the big hit, right? Down 320 basis points to 42.2. Higher wholesale discounts and tariffs are what are blamed for that. We'll talk about the wholesale in a minute when we get down here. Nike. A Nike Direct means you buy right from Nike itself. Nike Wholesale is it sells to someone else, and then you buy from their store. Nike Direct down 4% on revenues. Digital down 12%. Owned stores down 1%. $4.5 billion in revenue, not expected to return to growth in fiscal year 2026. Wholesale, different story, up 7%. Sales of $6.8 billion, and how much of that was, hey, listen guys, we're sorry about trying to bypass you, but we're back, and as a gift, here's a discount. How much do you want to buy? And it sort of worked, up 7%. North America up 4%. China down 9%, but that is a single digit negative number, not the double digits we've seen, down 20, down 17, only down 9, so it's firming up a bit. EMEA up 1%. Asia Pacific, Latin America up 1% as well. They've upped their tariff estimate, the cost. They said it would be $1 billion in costs. Now it's $1.5 billion in costs. So that is sort of a negative on that one. Some things are starting to look better. The digital is not as negative as it was. China's not as negative as it was. Wholesale is coming back online. And we do have growth, even though you had to get a currency move to get the win. A goal is still a goal. We'll take it. Guidance for Q2, low to single digit revenue decline. Gross margin down 300 to 375 basis points. That does not look good, but management is on the job. But this is retail. And we are going into the fourth quarter, which is a heavy Christmas shopping season, and you have a government shutdown. Yes, it's early days, but every week that this continues on, it's going to eat away at Christmas retail. And this is huge discretionary Christmas retail. So I don't know that I'm too bullish on much of this, but for Nike, I think I'd be comfortable on any pullback selling the 67.50 puts. 1 month out, or whatever front month it happens to be, or the 65 puts. Below that, I think I wouldn't mind owning it. It had a nice run up. I did the earnings vol on this one at 67.50. Did very well. Thank you very much, Nike. I did not sit under the wing. I sit under the left wing. I sat right below the wing. I thought, well, I'll hang out here. The premium was nice. But any pullback, the longer this goes on, retail will feel it. Retail will feel it first, because you are going into that critical season, and we're going into earnings season as well. But I would feel comfortable here on Nike. Let's have a look at Freeport and copper. Last week, Freeport had some bad news about its Grasberg mine and took a dump on everybody, down 20%. Actually, a little more than 20%. It was a little over 45 before it started the drop. Went all the way down to 35.31. You get 20% drop. You need a 25% increase just to get back. It came back 11.35% of that. That's not bad. I seem to think we're going to be in a $42 to $38 range, much as we were in this sort of range up here. I think we'll be in a price range in here for a while. This is copper's performance. This is the news that Grasberg was down, and then the realization that, wait a minute, there's lots of inventories, but maybe it'll be shut down even longer. So 5.088. If we're looking for the closing price on any metal, it's 2 p.m. Is the closing price that's set, even though it will trade till the end of the day. We got over 510 here on the ending price, but 508 is the fix. So if we're looking at the level of contango, because futures are usually in contango, and if the convenience yield increases, then you get a lowering of the curve. Or you have a spot that jumps up and drags the front month up, which would flatten the curve here. December 5.0 in March, so we are upward sloping 0.0585. For those that were in Costa Rica during the week where I did a curve flattening trade on copper, I did December March curve flattener at 0.0593, so convenience yield is showing up, so that one is in profit. I just think this is overdone. And I don't know that I would expect that to continue. So I don't know that I'm going to get the flattener that I wanted out of this. With the inventory levels, this is going to drop. Not only that, if we look at COMEX LME basis per ton, the basis per ton is $700 US. So that means if you move a ton of copper from LME to COMEX, at least the copper with a grade that satisfies delivery, you sell, or you buy at LME and you sell at COMEX, you make $700. LME has US based warehouses. So it's just a matter of, well, how much is transportation going to be to get it from an LME warehouse to a COMEX warehouse? If it's less than $700 a ton, guess what you have? You have arbitrage. That will increase inventories at COMEX. This is a COMEX price, by the way. That's not an LME price, that's a COMEX price. This will push downwards. I think it's this run up here in copper that allowed Freeport to run up as well, because, well, it's existing copper. While that the Grasberg copper is offline, its existing copper is now going for a hell of a lot more than it was before it happened. Before we had 462, 460 per pound. Now you're getting 510 per pound on the existing stuff that's left over. Maybe that makes up for a whole bunch, right? I don't know. I don't see that happening. So I don't know that I would bet on Freeport much above 42, and I think I would take it below 38. What does that sound like to you? Right? That sounds like if you're long shares, looks like you have a nice covered strangle in there as you sell the calls at the 42, you sell the puts at the 38, willing to take more if you want to take more. And if you have a curve flattener because of this arbitrage that's opened up, I don't know that I would bet on that much longer. I'll probably be closing this one this week while I have a gain. I just think it's overdone, and I don't know that we're going to get the flattener that I want. Gold, while we're on it, 39.08.80 all-time high, October 3rd 2025 on gold. It looks like nothing is going to stop gold 4,000. What a run this thing has been on. I think this time last year we were talking below 2,400. What a run. Okay, SPY and the related ETFs as well. Forward 4-quarter operating earnings 293.97, big jump from the 283. That's because we're now jumping forward 1 quarter instead of Q3 25 to Q2 26. We're now Q4 25 to Q3 26, and of course earnings estimates always do this every quarter. So if you take off this one and you roll to the 4th one, you have that jump in earnings. 67.15. Still with this, we're still pushing 23 times forward operating earnings. All-time high 669.56 on October 3rd. Not to be outdone, IWM 245.83 all-time high on October 3rd. Triple Qs, not really. October 2nd 605.73, pulled back on Friday. IJR, this is the profitable small cap. Still hasn't printed an all-time high. IWM is profitable and unprofitable, but if you adjust for the unprofitable ones, it is selling at a much lower forward multiple than the large caps. IVP for a week that just sort of grinded upwards. Look at what's going on over here. I wonder if this has to do with we have no data. Uncertainty should be higher, so premiums should be higher, even though the volatility on the index, the actual volatility was not higher. The implied volatility in the premiums is higher, 64th percentile. Keep in mind, though, we're still sitting at like 13% down here on IV, but IV has been under 12, under 13, 12, 11 for a while, so it makes it look on a percentile basis that you're quite high. 64 percentile over the last 13 weeks, up from 34 on actual vol. That really isn't that bad. It's not like you have candles here with really long wicks. Like if you had something like this and you had this kind of stuff during the day, then you could say a lot of volatility intraday, but not a lot of volatility intraday. And interday, not a lot of volatility either, but there we are. So maybe the market is pricing in a higher level of uncertainty, and we get that in the premiums. I'm good with that because I tend to sell premium more often than anything else. So I'm happy there. Reporting this week, Constellation Brands Monday, McCormick on Tuesday. We have Delta and PepsiCo on Thursday. Sector Spider seems to think Progressive is in there as well. I'm not fact checking any of this stuff. I'm just taking what it is. If it's wrong, it's wrong. Take it up with them. If you're paying them any money for your subscription services, you really need to take a step back and say, hang on a second here. Can I trust this stuff anymore? Next week, the big week starts. You got about 40 to 50 companies that are reporting earnings. So lots of earnings vol plays in there. I'm going to be doing, I think, quite a few of them. I've looked at the potential list that's reporting because, of course, I'm going with Sector Spider. The potential list. They can't all be wrong. I'm sure they're about 90% right. I do see some targets in there that I wouldn't mind playing with. And just to update on Freeport, which we just visited, it's coming up. Very quickly. I think it is in this week here, near the end of this week, we get Freeport. So, if you have positions in there and you don't know what to expect, because you're going to get an update, whether it'll be it'll take longer or it'll take quicker. I wouldn't wait for a press release for that. It's probably going to be on earnings. So we have a quiet week this week. I think all eyes are going to be on the U.S. government. Is everyone going back to work, or are some people permanently going to be separated from their paycheck? Don't know that we have any economic data, really, other than the Fed minutes and the Fed speak. and anything that comes out of a private company. I think we get University of Michigan this week. Other than that, earnings aren't going to really give us much guidance till we get into the week after. If we're still in a shutdown, at least we have good accounting data. Well, that's accounting / economic data based on earnings and guidance. We'll have that at least, and a lot of good. I hope this sticks around, by the way. I hope the higher levels of implied volatility stick around, because if we're going to do earnings vols, we want high vol on that, because that's where the money is made. Okay, one last screen to go through. These are some of the targets when we were doing vol trading in Costa Rica. These are some of the targets that we had come up with. RGTI, QUBT, QBTS. Here you're looking for very high IV. Look at this, 120% implied volatility, 100% over here, 126% here. IonQ has 108%. These are all in the quantum computing space. And look at the run they've had. And if you were watching on Friday, RGTI was up 14%. On Friday alone. QUBT was up 23% and QBTS up 13% just on Friday alone. And IonQ pushing back above 70, I think ending 73, 72 something, $73. All of them having a wicked day. Looked for news on QUBT, up 23%. Didn't really find anything but lots of insider sales. Maybe that is the Elon Musk sort of strategy now, that the worse the fundamentals are, the more you buy the stock. Oh, insiders are selling. Buy, buy, buy. Sales are dropping. Buy, buy, buy. I don't know. QBTS again, not a lot of information on October 13th. We already had this. North Wales Police are using their systems as a significant improvement in response times. RGTI went there. Found something. And it's small. Purchase orders of 5.7 million for 2 of its 9-qubit Novera quantum computing systems. Okay, so you have some commercial viability here. You're selling something, but 5.7 million. And to have after this big run up over here, to then add another 14% on one day, and then everybody starts jumping up. Seems a little aggressive to me. But these targets here, when we were playing them in Costa Rica, we were not playing direction. We were playing volatility. Direction matters little when you're playing volatility. All you care about is that it moves, and this stuff moves. And we try to trade it so that we're isolating just the theta and the vega. So these are still nice targets to use, but be careful. They have run up quite a bit. So, but they do have lots of IV. So again, if you need to get out of these things, the options provide you plenty of doors to exit from. IonQ announced it surpassed its AQ64 quantum performance mark. AQ is an algorithmic qubits benchmark, and it's something like something quadrillion, 2 to the 68. I don't quite understand all this stuff. Their computation space is the size of 2 to the 68. You'd have to look this stuff up. I haven't spent the time to dive deep on it, but it had improved performance on its benchmark. This space is on fire. If you're looking for volatility, if you know how to play volatility, it's here. I don't know that I would be too eager to play direction, although direction has been winning. With high vol like this, it doesn't mean one direction, it means it moves. And being that it is going up on what seems to be little in terms of the fundamentals, but big in terms of commercial verification. You're selling this stuff now, that's commercial verification. Okay, I would be cautious. Unless you know how to play volatility, then have at it. These are great for vol. But if you're playing direction on this, because of this high vol, strap yourself in, because it can go down as quickly as it went up.